You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. And today, before we begin, I want to remind you about all of these resources that if you have not had a chance, you're missing out. Because there's something called wealthformula.com, and there's all sorts of free stuff there. And everybody loves free stuff, right? I do. Free stuff like free books, like my free book, 7 Secrets of Eternal Wealth, an Amazon #1 bestseller, yours for free. And then George Newberry's book, Burn Zones. George is a good friend of mine. He actually used to be a multifamily titan. You know, he was a multifamily giant, had like millions and millions of dollars of real estate. His story is absolutely mind-blowing to me, and it's one of the reasons I really like the guy. So check his book out, too. It's called Burn Zones. He'll send you a free copy in the mail. See, I won't do that because I'm too cheap, and George will send you a real copy in the mail, though. So check that out at wealthformula.com. Also, I want to remind you, for those of you who cannot get enough of Wealth Formula and of yours truly, there is a way to get into the inner sanctum of the Wealth Formula community, and it's called Wealth Formula Network. And I would love to see more of you join this, right? Because you guys want to talk. Who is this for? That's the question. The question is, who is this for? And it is for people who love talking about money and investing, and getting sort of the insides and building the tribe of like-minded individuals. You know, I've said it before, I am probably not that interesting when it comes to being a guest at people's houses for dinner, unless you want to talk about investing or you want to talk about NFL football. Otherwise, I'm pretty much boring. And if that sounds like you, if you like to be talking about deals and talking about football even, and you want to be around other people you can do that with without feeling like you're being a lame-o and ruining the conversation, you belong in Wealth Formula Network. Now, the good news is that Wealth Formula Network, the community, is not only bi-weekly mastermind calls, Facebook communities, portals, additional top secret content that only is available to the members, but also there's a whole course associated with this, with the likes of Ken McElroy and Tom Wheelwright and Christian Allen and Dean Graziosi, all in one big package for you to go take advantage of. Go to wealthformularoadmap.com and join the fun. Now, as you know, maybe you don't know this, but I've been on a real kick lately to challenge myself to learn about things that I don't know about, and to challenge my own investing paradigms. Because I've talked to you in the past before about how, when I've listened to other people without doing a little investigation on my own, I have frequently found myself to being misinformed because I'm listening to the same people all the time, and I'm trying to get out of that. Recently, you saw me come out in a shocking revelation coming out of the proverbial closet of gold, and I saying that I don't actually see the point of owning physical gold. And surprisingly, no one sent me hate mail for that one. My point was that I thought, listen, you can hedge the economy with appreciating real estate with leveraged debt and cash flow to boot. Who needs gold? Anyway, I've had people on my show to prove me otherwise. I will continue to do so. And, if somebody proves me otherwise and tells me how I can make it into a useful investment, let me know. But yeah, outside of, owning GLD and selling options, I can't really quite figure that one out yet. We've also had, really good people on lately. Like Michael Flight was talking about Commercial real estate, I think he made a good case for it. It's maybe not for me still, but I like it when people come on and give me their opinion and they have a track record of success. And he was a very good sport, by the way. I think he's a good guy and he's a smart guy. And who knows? Maybe there's some value there. But listen, there's stuff like that where I've had dogmas where I'm like, yeah, I'm not really, I really like gold, but then I'm like, well, why do I like gold? All right, look into it and I say, okay, well, maybe I don't like gold because maybe I just like gold because everybody said I should like gold. And similarly with commercial real estate, it doesn't quite fit into my Maslow's hierarchy thing. The Maslow's hierarchy of needs and people need a place to live, that kind of thing. So I was kind of down on that. But Michael kind of turned me around, especially when it comes to, say, triple net stuff, right? I mean, if you had a ton of money and you wanted just a triple net Walgreens, Walgreens ain't going anywhere. So, you're going to make a bunch of money. The tricky part with that is yield, right? So, again, there are things to consider and you want to constantly be exploring new things, okay? Now, I started recently looking at this other thing, which was mobile home parks. And I know a number of you know that I have been interested in that and have been talking to operators. I've been talking to, individuals who do this kind of thing. And I was really initially very excited because my idea was this, right? If I'm looking at which effectively low income housing, then, maybe I should be getting significantly higher returns, right? I mean, that's kind of the way I think about it. Like if you're going to go in and buy a bunch of A-class apartment buildings, don't expect your yield to be all that great. Don't expect to be getting double-digit returns. On the other hand, if you're going in and you're doing big value adds and turning, B- or C+ class things into B+, then yeah, maybe then you're going to get higher returns. But on the other hand, if you look at, why would anybody buy D-class apartment buildings? You expect, it's a higher risk, so you expect a higher return. I started looking at mobile home parks and I expected the yield to be, frankly, significantly higher. And I think at one point it was. But listen, at the end of the day, no one buys low-income housing for appreciation. So I figured cash flow must be super high and there must be tax advantages off the charts. But honestly, that's not really what I was finding. And so I am, for the most part, sticking with apartment buildings and, a handful of things here and there that you guys know about. I like self-storage, et cetera, still. Now, recently, though, I'm going to continue to talk to people. Recently, I got asked if I'd like to have a guy on the show by the name of Jefferson Li. And I looked at his bio and I see, well, gosh, he's a Wharton Business School guy, and obviously Wharton's University of Pennsylvania Business School is fancy, top tier school, and obviously he's smart. He lives in the Bay Area, is being Silicon Valley, and then I saw him in his bio. He says that mobile home parks are better than homes and apartments as an investment, and I'm thinking to myself, man, them's fighting words for me, right? So I figured if anyone could convince me to leave my happy place in the apartment world and migrate out towards mobile home parks, it would be him. So I thought, well, gosh, let's have him on Wealth Formula Podcast. And so that's what I did. So I interviewed Jefferson Li. And when we come back, you're going to hear that conversation and you get a chance to make a decision for yourself if mobile home parks are right for you. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Jefferson Li. He is a mobile home park investor and entrepreneur and the founder of Park Street Partners, which has been in business since 2013. He's got an MBA from Wharton, a business school there, a little school a few people probably know, and started his career in Silicon Valley. Now he is focused on mobile home parks and even has his own podcast focusing on the topic. Jefferson, welcome to the podcast today.
Buck, great to be here.
So I have to tell you, first thing that strikes me, just as an aside, is that so I have a friend. I don't have that many friends in this mobile home park space, but the one friend I have who's really good in this space and who knows his stuff and is a great operator, actually grew up on a mobile home park. Hey, Mike, how are you? And so tell me, how does a guy who goes to Wharton, lives in San Francisco, end up in mobile home parks?
Well, Buck, as I say, when I woke up from the concussion, it just seemed like a good idea to be buying a mobile home park.
Right, there you go.
But more seriously, prior to getting into this business, I had worked in high tech out in Silicon Valley. I'd kind of done the whole crazy .com up, down, and sideways thing. Came out of that basically looking for value. Figured I was not going to do the sort of, crazy high tech investing. And again, really wanted value. And I'd always been a big fan of Warren Buffett and a very small Berkshire Hathaway shareholder. So initially, I just thought I would diversify out of the stock market, buy an apartment building, and obviously generate some passive income. So in just researching apartment building investing, obviously that's multifamily, I kept seeing these mobile home parks pop up in my search results, and it was maybe 1 in 100 multifamily properties were mobile home parks. They're few and far between, but they tended to trade at a higher cap rate, which is to say a lower price. And so I kind of, I found them part by plan and part by dumb luck. And I'm sure we'll get into this on your show, but in researching them, basically discovered why they're so much better than apartments or other classes of real estate.
Yeah, so let's talk about that because, I am a diehard apartment guy, so I'm going to obviously challenge you on this. You say mobile home parks are the best real estate you can invest in, basically better than single-family homes, which probably is, that, in my view, that's not hard, and apartment buildings. So tell me why I'm wrong about apartment buildings and that mobile home parks are better.
Yeah. So I'll start off with 2 words, leaky toilets and leaky roofs.
Okay.
Undoubtedly, you as an apartment owner, obviously own all your improvements, and all that repair and maintenance, those proverbial leaky toilets and leaky roofs, are on you. And I would guess, you tell me, I would guess your repair and maintenance budget is probably 15 to 18% of your gross rents. Is that fair?
No, I don't know. I'd have to look, but it may not be that high. But the other thing is, of course, we're doing things in larger scale, not generally, buying like 10 units or, we're syndicating 250, 300 units at a time. And have a portfolio of several thousand units. So it's a little bit different, I think, than necessarily owning one at a time. But no, I see your point. Your point is that this is more with mobile home parks. I think your argument is this is sort of more your triple net type model almost.
It's not quite that good, but we of course do have repair and maintenance just on the land. So that's plumbing, it's mowing. For our parks up in the north, it's snow removal. But our repair and maintenance budget typically comes in at 5 or 6% of rents. Mm-hmm. So anyway, so our repair and maintenance budget is much lower because, again, our tenants own those improvements.
Got it.
So this is something more like a parking lot business. Mm-hmm. Not quite perfectly, but certainly much closer to that business model than traditional apartments. And then I'll also just throw out that unlike apartments or most any other real estate niche, it's actually illegal to build any more mobile home parks. Pretty much every city and county over the last, I don't know, 30 or 40 years has changed, for instance, the zoning laws, density laws. So you just can't build mobile home parks anymore. Best guess is that something like 10 mobile home parks were built last year.
Mm-hmm.
And then probably about 500, that would be about 1% of the total supply of, say, roughly 50,000 mobile home parks. But about 1% of those, or 500, got plowed under and got redeveloped into some higher and better use. Could be an apartment. I've seen them developed into super Walmarts, student housing, other assets. So, in the apartment world and single family houses and retail and hotel, there's always at least the risk of overbuilding. Certainly when times are good, pretty much every other class of real estate is experiencing new competition.
Mm-hmm.
Only this niche really has shrinking competition. About 1% of parks go away every year. And then, of course, those folks have to move their homes into the remaining mobile home parks. So that's about 1% demand right there. Demand also probably grows about another 1%, just right along with the population growth. So that's about 2% demand growth per year. And then again, the supply is going away at about 1% a year. So you have about a 3% supply and demand imbalance, which again makes it a pretty unique niche within all of the world of real estate.
One of the things that you alluded to earlier is something I want to kind of touch on as well, because one of the things that I initially was kind of interested a little bit more in mobile home parks was this idea of, potentially higher yield. You mentioned, higher cap rates, et cetera. And so, obviously that got me interested as a guy who likes cash flow as a general rule. But,
Sure.
The world, as I've discovered in mobile home parks in 2013, when you started, is a very, very different cap rate profile from 2019. Is that accurate?
Certainly, cap rates have been coming down.
Mm-hmm.
I would say still deals can be had, at least in the Midwest, at, say, roughly an 8 cap, which I think is better than apartment buildings generally. And we look really to, of course, not only acquire at a fair cap rate, but to actually operate the parks better than they have been. So that'll be things like bumping rents, buying new mobile homes and bringing those into any vacant pads, or buying used mobile homes, or renovating used mobile homes that might be on site but just abandoned. So we actually improve the properties. So if we can buy them at about an 8 cap and still have some upside there from rents and from infill, we'll still do quite well for ourselves and for our investors.
So with an 8 cap, obviously one of the issues that we have an advantage in apartments, certainly in at least B class and decent markets, is that we can get non-recourse debt. We can get debt that is pretty significant loan to value. Can you talk about some of the issues that you deal with and effectively in low income housing in areas that may not necessarily be where the big lenders want to be?
It does vary. Generally, larger deals we can qualify for CMBS or agency debt. But indeed, smaller deals, let's just say that's deals under 2 or 2.5 million in acquisition price. That's almost certainly debt financing. So far, we haven't had too great difficulty getting debt financing. We tend to stay away from parks that might have a very high percentage of park-owned homes as opposed to resident-owned. And lenders are generally savvy that way. They tend not to like to take mobile homes, which is chattel, right? It's wheel estate, as I say. It's not real estate. They tend to not to like to take that as collateral. But most of the parks we buy would probably be 80% resident-owned homes. Some of them have been 100, and then again, quote unquote, all we're buying is the land. So we've been able to get that financed.
And what kind of loan to value typically can you get?
Anywhere between 65 and 75. We might have had one deal that went as high as 78% loan to value, but the normal range would be 65 to 75. Obviously, banks and the agencies in the CMBS world are all comfortable lending more on generally larger properties that are more full, and specifically more full with homes owned by the residents, not by the park owner. They tend, again, not to like to finance the mobile homes themselves.
Right, right. Talk about, if you would, obviously, again, just to compare and contrast, and I don't know the statistics for mobile home parks, but certainly historically, if you look at, larger quality apartment buildings, et cetera, I mean, you can get, you get your decent cash on cash, but improving the property and getting the appreciation on the back end is really a significant part of the IRR in those kinds of opportunities. Can you talk about historically the appreciation of mobile home parks?
I can't. I don't have any industry. This is a quirky niche, and there just aren't those sorts of facts and figures readily available.
Right, right. So overall, you wouldn't know if it's sort of relatively flat, or if it tends to have a higher trajectory, just in general. I mean, even without the, necessarily with the statistics.
Things are good. This is a business probably not unlike apartments where, they trade based on the cap rate. So if you can demonstrate that, hey, over the last 5 years, you bumped up your NOI 50%, then almost certainly your property is worth 50% more.
Sure.
So that's basically what our goal is. It is to get that kind of improvement over that kind of time frame.
If you have arguably, this is maybe the, is this the ultimate low income housing, right? I mean, is that fair to say or not?
So we have very few Section 8 tenants. That said, yes, our average tenant probably has household income of between 30 and 35,000 a year. So I guess that's certainly towards a low income housing.
Right. So does that limit a little bit sort of on your upside as you create value? I mean, certainly one of the one of the things we focus on apartments, and again, I'm just mostly as an educational thing, is we will frequently take a B- asset that's poorly managed, and maybe it's sub-institutional, and then we will go and force equity and turn it into an institutional quality asset and get the additional premium on that. For mobile home parks, do you have a little bit of an upside cap because you're ultimately dealing with people? Listen, if you're going to get to a certain point, you're not going to be able to afford it anyway.
Generally not. Keep in mind, we might be starting with a park that might have lot rents of $250. And over, say, a 5-year period, we might bump those rents to $350, maybe $400. So percentage-wise, that's a good increase. But in absolute dollar terms, to expect someone who's low income to pay an extra $100 a month really isn't going to break the bank, and certainly not if that's, say, $20 increments spread out over 5 years.
Got it. You, as you mentioned before, I mean, you're in the Bay Area, and I think and most of your mobile home parks are in the Midwest. Talk a little bit about what the the process is in terms of, what goes into managing those things, and are they just the same kind of management companies that you would have for apartments, or is it more intensive, less intensive? Are they easy to find in terms of management companies, et cetera? Can you talk a little bit about that an independent operator's perspective, someone who might be interested in doing something in a place where they don't live?
Yeah, so this is kind of one of the very few bad things about the mobile home park business. There really aren't nationwide management companies that do this niche well. This is not like, say, trying to find somebody to come in and manage a 400 unit apartment building. We're talking about, at least in our portfolio, the average mobile home park is right around 100 pads, and the lot rent, let's say, is $300. So that's $30,000 a month in gross receipts, and it's that's just not interesting generally to large, professional management companies.
Mm-hmm.
So to be in this business, right, you really need to keep operations in-house. So we'll actually almost always hire a manager directly from the park. We look for folks that own their own mobile home. And again, we'll make them the manager. They will deposit all the rents, call the plumber, the lawnmower, all those sorts of things. And we then have an asset manager. We actually have a couple in my previous funds. And they're overseeing the managers, and they in turn at that level, at the asset manager level, they're doing things like determining how much we're going to invest into renovating a mobile home that, again, might be abandoned. They make decisions like, how many potholes are we going to repair, or are we going to perhaps repave a park? But we keep that in-house because, again, that's one of the quirky things about this niche. The assets tend to be much smaller than apartments, and you really need to build up your own internal employees and systems and do it yourself to do it right.
And we're talking about people who are living on site. So, I mean, for each individual park that you have, presumably you're going to have a different set of on the ground management. Is that sort of like a caretaker model with an apartment building? Is that sort of what
I guess you can consider it that way? Yeah, they're again responsible for collecting the rents, filing evictions, calling for simple maintenance jobs like plumbing and mowing, and then again more major things like a repaving or those sorts of things typically are handled by our asset managers.
So obviously you've got you've got the asset managers now, and you've got you've got a fund. Tell me how, when you first started, how did you do all this stuff? Because now, certainly have thought about it myself at various times, and like I said, I was interested in the idea of potentially getting into this space a little bit. But if you are looking to go out and well, how did you do it when you first started? I mean, obviously you didn't, you still weren't living out in the Midwest, or maybe you were. No, you were in Silicon Valley or somewhere like that. How were you doing this back then? Were you just flying out there and buying something and then hiring somebody and basically keeping in touch with them on the phone? I mean, just in practical terms, how did that work?
Yeah, so I've evolved from doing not quite all of it myself to now obviously hiring other folks to do the management, the asset management, and the accounting. But yeah, when I got started with my first park, that was back in early 2007, I took many of the inbound phone calls myself from prospective residents. I just used Grasshopper, which I still use, to set up like a virtual PBX, and people could route calls just by pressing 1, 2, 3. So I took many, not all of the phone calls myself. That first property did have a manager who collected the rents for me. But I was doing, for instance, my own asset management. I was flying out and sleeping in an empty trailer about 1 out of every 3 weeks. I lived on site at that first park about 1/3 time, just bringing in, at that point, I was bringing in homes, setting them up on vacant lots. I was overseeing the crews that were doing the painting and the roofing and the electric and whatnot. And then when I was back in San Francisco for the other 2 weeks, yeah, I was working the phones, buying more houses, dealing with emergencies, and dealing with the crews, and then again going back out about 1 out of every 3 weeks to live on site and see it all happen before me. So now I've hired people to do that, and I did all my own books on QuickBooks. But now I've got a staff of 3 people doing accounting, 2 people doing asset management. So I've outsourced that, but having been the guy, again, answering the phones, doing my own books, and being my own general contractor, that certainly helped me now scale up and write job descriptions and help now my employees do those things that I myself was doing a dozen years ago when I first got into the business.
Sounds like fun. Listen, I
try to work a little more smarter than working harder.
Right. So right now, and again, just going back to the apartment comparison, because that's what I know best. So we have this interesting thing that I wonder if you're aware of. There's this new tax code. With the new Trump tax code, there's bonus depreciation, and so what effectively that allows us to do is take your typical cost segregation and analysis that we do on an apartment building, and normally that would segregate chattel, as you called it, and most of your buildings or your properties are chattel. To segregate that from real property. And a cost segregation analysis would allow you to, in the past, depreciate that over 5 years. But with the new Trump tax code, you can depreciate that over the first year. So typically that's about 30% of an asset in terms of an apartment building. So in other words, if I am investing $100,000 in an apartment building or syndication, and there's at 70% loan to value, I'm getting like a 1-to-1 write-off against other passive income sources. Can you talk? I mean, especially if there's so much chattel, can you talk about some of the tax benefits of mobile home parks?
Sure. So they're numerous. We tend to depreciate about 75% of our purchase price
in the first year.
I believe that compares pretty favorably to apartment buildings. So indeed, about 25% of our purchase price is the non-depreciable land. But we will then do some cost segregation on any individual mobile homes that we own, and break out things like appliances and carpets and things like that. But keep in mind then, what the assets that we're buying and putting on our books are things like roads, which are depreciable, I believe, over 20 years. The pipes in the ground are indeed 27 and a half. We've typically got fencing and signage. That is, I believe, 7-year property. Some of that maybe it may qualify for that sort of bonus depreciation. And then ultimately, if we overpay, that's amortization of goodwill, and that'll come down over 15 years. So on average, again, we're able to depreciate 75% or amortize it, but we do it over about 18 years rather than have to be spread out over 27 and a half, which I think is more typical for more typical real estate where you buy the bricks and mortar.
Yeah, although the nuance there, of course, is if we're taking 30% of the asset and depreciating that over the first year, that basically that's the $1-to-1 loss on every dollar you invest. So that's an appreciable benefit there. But if you have that much, and if you can have bonus depreciation on top of that, what does your typical K1 look like to your investor? Do they have 100% loss in the first year, or are they? Do you have a sense of that?
I'm not going to be able to give you a real clear answer on that, because to be candid, the last acquisition I made was about a year ago. So I'm just launching my new fund. So I don't believe any of what we've done so far maybe was done in time for the new bonus depreciation.
Okay.
So I don't know what what my K1s will look like for folks in my current funds. But I know my accountants are very sharp, and if they can take bonus depreciation and generate that sort of one-to-one, they certainly will.
Sounds good. So tell me about the podcast. Why'd you start a podcast? What is it called? And tell us all about it.
Yeah, so I started the industry's first mobile home park podcast. It's simply called Mobile Home Park Investors. Folks can find it by going to mobilhomeparkinvestors.com. And I started it basically to really to raise money and some deal flow. But I get now about 16,000 downloads a month. Mm-hmm. And I get folks, I don't know, it seems like somebody almost every week says like, hey, I've heard about your podcast and, might want to invest. And then I have gotten some deal flow. It's probably more like 10-to-1 investors to deal flow. But I did, for instance, buy a property in the Raleigh-Durham metro area from some folks that had listened to the podcast and knew about an off-market mobile home park.
What is the podcast focus? Are you teaching people about how to manage these things and how to buy them, or is it more just talking about your fund, or what exactly is the sort of avatar?
So the content is really much more about how to find and operate mobile home parks.
Got it.
We've covered some about legal structure and land trusts and other ways to own them. We've had a range of guests on. For instance, we've had Jim Clayton on. Jim started Clayton Homes, which was and is the largest manufacturer of mobile homes. So he owned a couple of parks, but he was mostly a manufacturer of the homes. He sold that business to Warren Buffett. I believe he's now a billionaire. Mm-hmm. So we just got Jim Clayton on the podcast to talk about his life, lessons learned. We've had other guys on that do, for instance, specialize in although it's very minimal, but any new development of mobile home parks or renovation and improvement of existing parks. We've had a number of folks on from Wall Street that cover the three publicly traded REITs, Equity Lifestyle, Sun Communities, and UMH are the three public REITs that specialize in owning mobile home parks. So we've had some Wall Street analysts on. We've had some mortgage brokers on just talking about why you might want to get bank debt on a mobile home park versus CMBS versus agency. We've had people on from the agencies, Fannie and Freddie. So basically, I've now actually just this Thursday releasing my 120th episode. So everybody is directly involved in the mobile home park business in some way. We're doing online marketing of parks, providing insurance to park owners. Anyway, so there's just no shortage of guests to have on, and then some other people that have bought parks, and I'll just ask them how and why they got into the business, how they found their first mobile home park, how they run it. So there have been a number of sort of case studies of other people that have gotten in the business, and then of course I've talked about the parks that I own as well myself, and then with my partner in my previous two funds.
Sounds good. And how can we learn more about you?
So the website is parkavenuepartners.com. And there's an intake form right on the homepage, parkavenuepartners.com. You can just put your name and information in there. I'll get in touch with you. There's a phone number right there on the homepage. They'll also find some links there that simply say invest. And that'll take folks to a page that has some information about my current fund. My track record has been returning between 8 and 12% a year cash to investors. And we haven't yet sold anything or recognized any equity appreciation. So that's been the kinds of returns we've been able to generate just from actually operating the properties. We certainly do think there'll be some back-end weighted
Right.
capital gains as well.
Sure.
But nice to be able to generate high single digits, low double digit cash returns just from operations for our limiteds.
Sure.
So again, parkavenuepartners.com.
Got it. Well, listen, Jefferson, it was really great to have you on the show. Appreciate it, and hope to have you back again sometime.
Very good. Good luck to you, Buck. Thank you.
We'll be right back. All right, welcome back, everyone. Thanks for listening to the show today, and I hope you enjoyed that conversation. I think it was pretty interesting, and I'd love to hear your thoughts about it as well. Speaking of that, you have easy access to me vis-a-vis, well, you can email me, buck@wealthformula.com. But we're going to have an Ask Buck show pretty soon where we do these, which I prefer, generally speaking, that you go to wealthformula.com and you see this thing where you can basically record your questions. And so I would love for you to start doing that again. So that we can have a very, very nice Ask Buck show. And you can ask me anything you want, or you can make comments, whatever you want. But these are some of the more popular shows that we have. And again, if you're shy and you don't want to record your voice, you can just also email me at buck@wealthformula.com. And by the way, yes, I do read my own email. I don't know how people can just outsource their email. It doesn't work for me. So let's talk about, this interview that we did. So what's my take here? Am I convinced? Have I converted? Am I now going to move into a mobile home park? Well, no, I'm not going to move into a mobile home park, and there's none in Santa Barbara anyway. But here's my take, folks. Okay, so Jefferson, basically, his sounds like about, at least with his fund, about 8 to 12% cash flow. He said that the cap rates are about 8. Leverage is a little bit limited for the most part. So the returns of 8 to 12% is, of course, doesn't sound bad, right? I mean, it's certainly within the ballpark that I would look at things. My take on this, and again, if you have a different take or you want to challenge me on this, let me know. But the thing that I can't get out of my head here is, listen, I'm okay with 8 to 12% returns, cash on cash. But remember, I have this thing about, okay, if you make 10% returns and you're just expecting cash flow, you're just getting your own money back for 10 years, right? So that's not super exciting to me. It really isn't. And what's really exciting to me is when you can make a profit. And the issue here is, my biggest concern, and again, I don't know the answer to this because it sounds like there isn't any historical data for this, but how much do mobile home parks really appreciate? And if they do, wouldn't you be pricing people out? Because effectively, this is the lowest rung on the low-income housing, place. It's not like you're gonna take a mobile home park place and turn it into a B-class, apartment building and sell it to an institution. That's probably not going to happen. So that's my biggest concern is the appreciation, because at the end of the day, I think investing is holistic, right? And people get really excited about returns on an annualized basis. In terms of cash flow, of course, cash flow 8 to 12 is good, but a 10-year hold without liquidity, I don't know. It's not probably for me. Short-term debt, in the form of AHP or, even with the, oil and gas thing I had with the UCC filings and these multi-million-dollar companies, they're paying similar amounts with significantly more liquidity. So for me, I don't know that I'm convinced, but I will tell you that I certainly think, you wouldn't be crazy for going in that direction, particularly maybe if you think you can, get a little bit more out of it. If you live in the Midwest, maybe you buy your own or something like that, and you probably could get better returns. But listen, obviously Jefferson is a smart guy. He's smarter than me when it comes to mobile home parks. So maybe you ought to listen to his podcast. But right now I'll stick with my affinity towards apartments. I'll encourage you to go and make your own decisions. Listen to his podcast, read up on his stuff, but think about all of this stuff don't think about it in a vacuum. I think when you get caught up too much on, cash flow numbers, it's not always the best thing. I generally like to look at annualized returns and IRRs, etc. You want to see significant growth on average per year. Anyway, that is it for me this week. This has been a good show. It's been interesting for me, hopefully for you too. Make sure you, again, consider the Wealth Formula Network at wealthformularoadmap.com. And again, feel free to give me a 5-star review by going to wealthformula.com if you like what I'm doing. And that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.